So let's talk about sector analysis in particular. How does an investor, professional or amateur, use sector analysis to have better returns?
So our process is different than most people's process. Historical analysis really does have a play in sector-based analysis. So we combine both macroeconomic data, fundamental data, and use it in a probability-based approach. Obviously, not everybody can do that, but sectors are a very, very unique asset class because they're so diversified in terms of the spread between the top performing sector and the worst performing sector, much bigger spread than, say, value or growth. You can use them in a variety of ways. We use them at Fidelity to produce alpha. If technology is going to be one of the best performing sectors, then we want to be more exposed to technology and, say, less exposed to, say, utilities. But other investors can use those as solutions and as baskets to enhance their portfolio. One of the unique things about sectors is that you can bucket them into defensive sectors and cyclical sectors. And the defensive sectors have a very clear pattern in history. Value and growth don't have those similar clear patterns. So when you look at consumer staples, healthcare, utilities, and telecom, historically, if you just equal weight those, you've had in excess of 80% odds of outperforming in a down market. But you actually don't give up. If you extend your time horizon, you don't give up outperforming the market over long cycles either. So your risk reward is quite positive. So if you're an investor that says, I don't know how to use sectors, you could use that as one of your solutions. Say, this is a portion of my money where I want to be exposed to equities, but I want it to be just a little less volatile, and I want it to outperform if there is a downturn. You can use sectors in that fashion as well.
And so which sectors are poised to outperform from here, and why?
So I think to know where we're going, it's important to understand where we've been. So what we saw was what I would call, from a historical perspective, a very traditional defensive rotation from 2014 to 2016. And that was based on the fact that profits contracted. We didn't economically contract, but you see all the time profit recessions, usually half the time, I should say, profit recessions without economic recessions. 1998 being the closest example we have, but it happened in 1994, 1966, 1986, 1987, that era. So this does happen. What we see is, despite the fact that there is no economic recession, stocks behave in a fashion almost as if there is in this defensive rotation. And a defensive rotation is when those sectors that we talked about being the stable sectors, consumer staples, utilities, healthcare, telecom, because you buy your toothpaste, you go to the doctor, you turn on the lights, you always have your cable on or your phone. Those are more defensive than the cyclically oriented sectors of technology, financials, industrials, where you might not, if there's troubled times, buy that additional iPhone, get that bank loan, or buy that lawnmower, right? So you see that separation, and that separation is fairly typical over time in terms of the alpha. So what we went through from 2014 to 2016, in my view, wasn't necessarily based on interest rates, low rates, bidding up. It was all based on the corporate profit recession that we saw. So if that was the key theme that got us here, that is the key theme that we need to think about as we emerge from that. And what we've seen is global leading indicators have stabilized and turned up. It looks to be a durable global expansion, not just led by the US. And if you look at history, you can see that profit cycles are correlated to investment spending cycles, and they typically last 2 to 3 years. So with that as your framework, I think it's important when you do sector analysis to have a backdrop, because it allows you to do that. You can make sort of bigger, higher level bets. And then for each individual sector, have the fundamentals and valuation working for you. So with that, you have to be pro-cyclical, say shifting away, tilting away from the defensive areas, and looking for sectors like financials, technology, industrials, and discretionary that both perform well in that corporate profit recovery backdrop and have their own pluses in terms of fundamentals and valuation.
So those are the four?
Those would be the four.
Denise, thank you very much.
Thanks for having me.